Hi, if you're interested in where the real estate market is going in 2025, I want to invite you to join with me on this slide presentation developed by Gary Keller at Keller Williams. I am a Keller Williams real estate agent based in Seattle. This is a national trend watch, and I just want to go through some of these slides that Gary shared with us at our recent national convention so you can get a look at where the market is going. And of course, we have a disclaimer about the data. And what I want to take a look at and what we're going to be highlighting here is the trends and statistics that drive the U.S. housing market. So this is how many sales there are, what the prices are, how many there are to choose from, those types of things. We're going to go into this step by step. So here we're looking at the annual home sales in terms of number of single family homes that have been sold each year. And as you can see, the yellow bar is 2025. We're looking at a few more homes sold than last year, but overall we are below our average number of homes. This means not as many transactions are expected to be taking place overall. And month by month, we're looking at January, February, March, April. Comparing the pink is 2023 to the green is 2024. And we typically see this cyclical market. So here in Seattle, our best markets are spring and fall. Overall, nationwide, we're seeing most of the transactions, most of the dollars change hands mid-year in the summer when we have the best weather. And then, of course, things tend to slow down during the darker months, the colder months, the holidays, those types of things. And what I do want to point out to you on this slide is that the green bars, 2024 was a little stronger toward the end of the year than 2023, which was the first full year that we kind of had that interest rate shock. The interest rates had just started going up at the second half of 2022. Now, here's a look at home prices from an interesting perspective. We compare the prices to this green sort of aqua trend line here. So all else being equal, we expect home prices in the United States to increase at about 4% per year. This is the long-term average going back to 1990. So what we can see is that when we have years where things pop up and they're above trend, for example, in that run up to the market crash in 2008, we had more than usual homes selling. And then we kind of made up for that post 2008 where the things were softer for a while. Now we're looking at a similar situation where we were above the trend line for several years due to COVID, right? Interest rates were low. We had a lot of transactions. People were working remotely. A lot of things were shifting around. So we had another several years of being above the trend line. And it looks like we will still continue to be above the trend line. But what this points to and what this suggests is that we are going into a softening home price market. I would expect some sort of further correction to counterbalance all of those haymaking years during COVID and low interest rates. Here's another way to look at it, the home price appreciation during different periods. So this 2001 to 2005 was kind of the lead up. We were having easy money, right? Easy money makes home prices go up. This was the no doc loan period. And so we had a lot of people getting into houses, buying homes, speculating on homes and investing. And then the bottom fell out of that money market. We started seeing a lot of foreclosures and a downward spiral in housing where homes actually lost value, 12.9% in value during the worst year in that period, looking at a nationwide perspective. And then we got back to normal. So then we had a nice little run of normalcy. And then here's COVID, 2020 to 2022. Again, easy money, very low interest rates. Everybody can afford a house. Everyone's moving because we're working from home and we can work remotely. So again, we had a lot of homes trading hands, a lot of multiple offers on homes, and we had a lot of home price appreciation during this period. And now it hasn't fallen into the negatives, but it's been very flat. I think what's helping us not be negative right now is that a lot of people have a very comfortable mortgage. They refinance into like a 3% interest rate loan and they can just stay there. They're sitting on a lot of equity. They don't have to sell. It's not this situation where they were in an arm where it came due in 3 years and the interest rate adjusted and they couldn't afford it and they had to sell. These people were forced to sell and led to foreclosure. These people are not being forced to sell. They're just sitting. They're just waiting. Here's again another look back at historical appreciation rates. And we just had the biggest housing appreciation rate period at 21% price increases on homes. And you can just see how this is out of proportion to other high periods of home appreciation. So you can see here when we had other high periods of home appreciation, we didn't necessarily have a crash. The crash here again was driven by some fundamentals and how the mortgages were being created, whereas these were driven by other economic factors, right? Interest rates and things like that. Inflation again with the oil crisis, I suppose. So here we did have a correction right away when they cranked interest rates up so high on us, but we are not expecting to see a lot of loss of value. In the Seattle market, it's softened up a little bit, but we'll probably see a flattening and just a stagnation with where we are until we kind of catch back up to where we should be on that trend line of 4% growth year over year. This here is a look at inventory. This means how many homes are sitting on the market available for buyers to shop and buy from. And the blue line here is a balanced 6-month inventory. So this is what the market considers balanced. I hear some people say 3 to 6 months, but typically that means it's not a buyer's market, it's not a seller's market, it's kind of fair, it's kind of even. And we have been for the last decade and a half below that level. We have not actually been above that level since that recovery period after the 2008 crash. So what that means is that there are not very many homes to choose from. Builders are not keeping up with the demand for new housing. And so homes sell quickly. It's a seller's market, and that tends to drive prices up. And here's a look at the mortgage rates. So the blue line is the mortgage rate, higher or lower, although the bars in the bar graph, higher or lower. And then the dotted line across there is the historical average interest rate between now and the 1970s, from before I was born. So this is a 50-year average of mortgage rates, and it includes a very high interest rate time period from when my parents were buying the home. We hear those stories, 12%, 14% mortgages out there. If we look at a shorter period of time, just going back to the 90s when I was in middle school, we are looking at a lower average, but somewhere in there, 6 to 7% is what the historical average is. And that's right where we are right now. The pink line, the yellow line, we are right in that average. So even though it seems tough for us, it seems like we've had some price shock with our interest rate, we are not anywhere near a historical high. We are right where we might expect to be in a balanced, normal type of market. However, these do seem like high rates to us. They are the highest that they have been in the last couple of years. That's the highest mortgage rates that we have seen for this generation of home buyers. So let's see, in January of 2015, what was going on then? That was about 10 years ago. So that period of time, we have seen mostly lower interest rates, which continue to drive housing prices up, part of that recovery from 2008 in the housing market. And now we see higher interest rates, which has had a cooling effect and a slowing effect on home price growth. If we look at where we are as far as all the people who own homes today, what is their mortgage rate? We have 22% with a rate of 3% or under. We have 3 to 4% on another third. So over half of the mortgages are below 4% interest rate. And then 16% are at 6%. These are probably homes that have transacted since that rate change in 2022. Almost everybody else was refinancing during that time or else paying off their home. And so what we can see here is that 3/4 of the homes have a mortgage less than 5%, And so it makes it more expensive even if they were to buy the same type of home. We have $1 million home over here, we're buying $1 million home in the next town over. It becomes significantly more expensive due to the higher interest rates. And so that to some extent does lock people in, and they don't want to move unless they have to. It's a little bit expensive. It's a luxury to move when you don't have to due to that interest rate change. So let's take a look at how this impacts affordability. We hear a lot of people in the younger generations right now saying they cannot afford to buy a home. Are they right? Or are they just whining and they need to suck it up and be serious like the boomers did, right? So my parents are boomers. When they bought their house, it was probably right back here in the 70s. And things were a little bit more affordable. Now going into the 80s, that became less so for a while, a moment in time. And then things have been relatively affordable, trending near this historical average green line. But we are up above the green line right now. That means that things are more expensive. The principal and interest is higher at 32% of your take-home income than it has been in the past. And I think there's a strong discrepancy between where you are. In Seattle, I would say that's an even higher number because this is a very high cost of living city. Perhaps if you live in the Midwest or somewhere less expensive, then you can buy a home that's a little bit more reasonable, a little bit more in line with your money. But you can see, based on this chart, that we are at a relative peak of unaffordability for homes right now. It's higher than the average from the 1970s, and it's also higher than the average from the 2000s. So we are above average. Things are more expensive right now. It has happened before with the 2006 market there when home prices just spiraled 20%. And then it happened in the 80s. But for the most part, they're right. It's a tough time to be entering the market as a first-time buyer. Now let's take a look at the United States economy, because this is very much in the news, very much relevant to the new change in administration, and perhaps predictive of what we can expect to see in the housing market going forward. The economy affects the affordability of things like lumber, which impacts new construction, and it also affects things like how much money people are making. Are they getting jobs? Are they participating in the workforce? Or are they sitting it out? So let's take a look at this. GDP is gross domestic product. This is how much money the country makes as a whole. And it looks like we're kind of right around the normal. So it's gone up 2.8%. And quarterly, we're similar. It's not looking too rocky over here. It's looking pretty smooth. Unemployment is how many people want jobs that can't find them. And we're at 4%, which is going higher. And it's not great overall. And I think there has been some discussion of also the tired worker. If you have been looking and looking and looking for a job and you can't find one, you kind of give up and you don't continue to look. It's a learned helplessness type of thing because there are just no jobs out there. And so those workers that have withdrawn from the chase to find a job might still, be someone that you would think you should count as unemployed because they don't have a job. But if they're not actively looking, they don't count here. The more people who are unemployed, the fewer people can buy homes. Also, when the unemployment numbers rise and we can't find jobs, that tends to be bad news for the economy. The more bad news we see in the economy, the more likely we will have the Fed ease interest rates, lower interest rates a little bit to stimulate the economy. So bad news for the economy is typically good news for interest rates in terms of having them come down and be more affordable. Looking at unemployment, we're still relatively low from a historical perspective, nothing really to worry about or panic about here. Let's take a look at personal savings rate. How much money do people have in the bank? This is a good indicator of whether they feel they have money that they can put into a down payment, for example. They can spend a little bit more on the rent. If people are not savings, they're just living month to month, it's very hard to move into that home ownership status. Now, here's the yellow trend line. Since the 1950s, people have saved on average about 8% of their income. But we see here on this pink line that the average has come down to only 5% of their income being saved since 2000. So this is probably due to a feeling either less importance of saving or higher cost of living. People just can't do it. They feel like they're just scraping by. And where we are right now is even lower than that. People are only saving 3.8% of their funds, which is, inflation has been a big talk in the news. We have a little bit of higher, trending unemployment. And so people might be feeling that they don't have enough money to save. If they can't save money, they might not be able to afford to buy a house. Now, where are we with inflation? I just mentioned that had been a big topic in the news. And I think there was a lot of talk during COVID about the government printing money, drilling the interest rate down to very low numbers and really stimulating the economy and maybe overstimulating it there. You can see our inflation popped up really high, higher than it's been in the last, since the 1990s, as far back as we go here on the data. So significantly higher than average, outside of the norms. And it looks like we are now returning to this average target rate of 2%. And as that goes down, there's less need to slow down the economy with high interest rates. So we would hope that as inflation settles down, we can see the mortgages getting a little bit easier to deal with as well. Now, what are the economic risks in 2025 moving forward? Number one is unpredictable policy. We have President Trump telling us that there are going to be tariffs that might affect trade. Immigration, we're trying to get people out of the country and not in. We have different regulations. DOGE is out there cutting back government spending to the tune of billions of dollars. So we don't know yet how all of these changes will impact the economy, but there are pretty big changes going into effect. We've also seen a lot of natural disasters, right? A lot of places are burning to the ground. A lot of places are flooding to the ground. Hurricanes, tornadoes, earthquakes, right? Other things that might happen can have a serious, devastating impact to the local economies and also have an impact potentially nationwide as we give support, or if major industries are affected there, the downstream industries will be affected too. And then just in terms of international conflict, we've got things going on all across the world. Things are afoot, and that can potentially affect real estate, but really the things that matter most are the employment levels and the cost of money, that's the interest rate, as well as the price of real estate. So how is this actually affecting everything? Not too catastrophically at this point. We're looking at the percentage of homes that have had to change their price, to lower their price in order to get the property sold. And we're right in range with where we have been. We're not seeing a lot of price dropping or panic selling or anything like that here. We are seeing new listings. Actually, more new homes are listed in 2024 than 2023. And based on our first month data here in January, we had 406,000 new listings compared to last January, 325, and the January before that, 300. So it looks like we're outrunning this locked-in effect. I refinanced at a great rate and now I don't want to move. We're starting to see that become less important, and probably life just catching up with people. Yeah, we've downsized, we had a baby, we don't want to go on like this forever, we need to buy another house. So that's becoming less optional and more necessary to move forward with the life and to sell. Now, as far as distressed sales, there's really not much to talk about here. After the 2008 easy money dried up, we had tons of distressed sales and foreclosures and short sales, and there was a whole industry around that. Now it is down and has been down for a long time. People have a lot of equity in their homes right now. They refinanced into a lower payment mortgage and their home went up in value over 20%. So if they want to move, if they, for example, lose their job or have a medical emergency and can't continue to hold their house, they can sell it the normal way and put a couple $100,000 in their pocket. They don't need to go into foreclosure and have a distressed sale in the majority of cases. Likewise, here's underwater means that you owe more on your mortgage than the house is worth. It's a $100,000 house and you owe $120,000. We're not seeing that now. People have a lot of equity. Very few homes are in a position where they owe more than the house is worth. As far as credit conditions go, the availability of credit has been very stable. They're starting to loosen it up a little bit, but overall it's just slow and steady here. And what about new homes, new home construction? Is this the answer to creating more inventory for people? It looks like we are still sitting below the long-term average number of new homes built, and we have been well below for the last, since 2008, almost 20 years now, we've been well below that. So we don't have enough new inventory coming on the market to meet that demand. And how is it going for the builders and developers out there? There are significant challenges in being in the home building industry because of regulatory burdens. Land is also becoming very expensive. In a lot of our big cities, all of the prime areas have already been built up. So you have the choice of buying an expensive lot, buying a tear down home, getting rid of the house there and building something else, or buying a home that's pretty far out into the suburbs and rural areas, or buying land out there. So there's not as much land. It's not the Wild West where you could just go out and get 40 acres and build a housing development. It's becoming more expensive to buy land in a desirable location. What we saw during COVID was that material prices went sky high. Everyone was doing their remodeling, and now we've got tariffs and other things like that. So that's an issue. Supply chain issues. We've all heard that term become popular in the last couple of years. And then labor as well. And I know with the ex-migration of a lot of illegal labor, I feel like there have been builders out there who have been utilizing illegal migrants for their labor needs, who are, putting together those housing developments, and now they've fallen silent because all of the labor is gone. So making sure that there is labor that's well paid and doing good quality work is very important to the overall business model of being a builder. And then also having profitability constraints and project feasibility. Sometimes the builder is forced to put in, for example, they're building condominiums upstairs and a retail space downstairs for a hair salon or a coffee shop. There are a lot of new construction buildings where they want these walkable downtowns, and so they're requiring this retail on the bottom. The only problem is that there's no businesses that want to buy or lease those spaces because they can't afford to have the hair shop there. Like, not enough people are there to support the business. The coffee shop, same thing. No one wants that business location, and so those things sit empty. They oftentimes will have to put in a certain percentage going to homeless or low-income housing units. They might have to put in handicap units and a variety of things that are meant to encourage fairness, but also come at a cost to builders. So that just cuts into profitability, and there's a lot of risk in being a builder. And so if there's not big profits, they oftentimes just won't undertake the project. Taking a look at student loan debt here, this has become an issue. You can see the blue line, how much of an increase we've seen in student loan debt over the past 20 years. And then additionally, the yellow is other types of debt. This is credit cards, car loans. So folks today are really burdened by debt to a significantly higher level than they have been in the past. Again, that makes it harder to get a house. Here we're looking at home insurance. So the home insurance has gotten really dicey with all of the floods, the fires, the different problems. I know here in Washington State, we have some areas where there have been farms with houses there for decades, and now these people are being told, you're in a high-risk area. We're not going to offer you home insurance at all. And so without home insurance, not only are they at risk where they live, but it makes it very difficult to sell the property because the bank is not going to want to give you a mortgage on a home that they think is going to be washed away by flood. So insurance rates are going up, and the insurance companies are becoming more picky about where they are willing to insure. So we're having a lot of conversations about this here in Washington State right now, and I'm sure in many other areas as well. I own rental property in Florida. They've had a lot of conversations there about short-term rentals are having troubles getting insurance, and prices are going up on those insurance policies. And I actually have my insurance through a company that's called Citizens, which is basically a state-backed insurance fund, because with the hurricanes that they have, it's so expensive and so high risk. It's a difficult market for private insurance companies to operate in. So keep an eye on that. I'm curious if you've checked your own interest rates or seen your own interest rates change at your home in the last couple of years. But here, the areas in red are where we've seen the biggest incidence of non-renewal of insurance. So again, a lot of these Gulf Coast states here and California, as well as sort of some tornado states, I'm imagining. I don't know what they've got going on in Massachusetts. Maybe you guys know. You can tell me what's happening there. And then the last thing that I want to talk about here is this idea of generational wealth transfer. We have a lot of boomers. My parents are boomers. They have been, building up their wealth through hard work, savings, and investment for decades. And their house often represents a lot of their wealth. And from what I have seen, a lot of boomers were predicted to be moving out of their homes and into assisted living. And that has not come to pass. The majority of the boomers seem to prefer to age in place as much as they can. They want to be independent. They want to be in their own homes, and they're tying up their wealth in these homes. So they're not actually freeing up that real estate to go to the next generation. And it becomes harder for the Gen Z folks to buy their first property. The good news and what we're seeing is that while the boomers do control over 50% of the assets in the United States, and a significant portion of that, it looks like about 20% of that is tied up in real estate, a lot of them do want to give wealth and start to transfer that wealth to the next generation before they die. On average, they want to give away 30% of their wealth while they're still alive. So the question then becomes, and this is a great question to talk about with your real estate agent, with your CPA, with your financial planner, with your estate planning attorney or theirs, how can we do that? How can we have gifts? How can we maybe finance things? Maybe they're going to be the bank and give you a mortgage at a pretty good interest rate. Maybe they're going to help you with the down payment. So there are a lot of different ways that boomers can assist those Gen Z grandchildren and their Gen X, millennial children to help with the home ownership journey, putting money into colleges and things like that. We do have a lot of generous people with a lot of money under their control. So helping think through and have those conversations about how they can help you reach your housing goals would be a significant opportunity there, I would think. Now, if you're thinking about buying a home for yourself and you're a first-time buyer, here's some interesting information from the National Association of Realtors. So what we have here is that first-time home buyers are representing a smaller portion of home buyers than ever before. In the past 25 years, we've had between about 30% and 50% of all transactions going to first-time home buyers. Now we're not seeing that. Things have gotten so expensive that first-time home buyers are more locked out of the market. They can't get in there more so than any time in the past. So what this says to me is if you are a first-time home buyer, it's time to down level your expectations to that little house with the white picket fence and start thinking about what you can afford to get your foot in the door. Maybe a condo or a townhome, or renting out a spare room to a roommate to help you make the mortgage, doing something creative to help you get into the real estate market and start participating in that appreciation growth so that you don't continue to get more and more priced out as the homes go up in value, but your savings don't, your buying power doesn't. What are the compelling reasons that people are buying homes? The number one is they want to buy a home. I mean, that's kind of like, I don't know, that's not very helpful data. But 10% want a larger home, 14% want to be closer to family and friends, and 8% are having some other kind of change in family location, maybe a death, a divorce, a birth, something like that. How long does it take you to actually find a home? This hasn't changed much. It takes about 2.5 months. And I would say this is pretty typical for what I see. I always encourage my clients to look at 10 homes before they start making offers, just to learn the market and see what's out there. I know some people really push their clients to make a fast decision, and some clients are forced to because they have a timeline. They have to find something this weekend. They have a job transfer that's bringing them out here, or perhaps they want a very specific type of home. They want a lake view home or a view of the downtown area. And if that's the case, there may be very limited inventory. It has to be on this hill. It has to be in this price range. It has to have this view. There are 5 homes altogether that fit that. We're just waiting for one of them to come onto the market. So if you're in an outlier situation, it may take more or less time. But this, I think, is a very comfortable amount of time, and we can see it's stood the test of time as well, been fairly consistent over the years. Now, how are people finding property? Number one, they're looking at homes for sale online. It's really great. I think there's so much transparency and so much data available to people who are in the home buying process. But I think this also burdens them with the feeling like they have to do it all themselves, and they have to be, like taking it to Amazon where they do the shopping and they click the buy button and they're done. It's a very complicated process. It's a lot of money at stake. And there are a lot of market dynamics that affect things. What you see now might be completely different than what you see 3 months from now. You might have missed your window. You might have had some emotional blockers. There's a lot going on there. And so I really encourage everybody to speak with an agent sooner rather than later, and really lean on them as a resource to help direct you as you go through this process. So some started by contacting their realtor, which is great. And then a lot did some variety of online research. 7% started by contacting a mortgage broker, which I usually think of as step number 2 after you talk to your real estate agent. But getting connected with a lender who can tell you how much you can afford is really valuable. Now, this tells us where people are getting information about real estate, and I'm really happy to see that over 85% are using their real estate agent, it looks like, as their primary means of getting information. Now, other people are saying they're getting it on their tablet. I don't even know what that means. I assume they're doing some sort of research on their phone, going to different websites, but that's a real mixed bag. Some sites are great and some are not. But I think in general, having a realtor as your primary point of contact, and then supporting the conversations, maybe thinking of questions to ask through your supplemental research is great. But what we're not seeing anymore, for the most part, is things that are printed, right? Television, billboards, newspaper ads, that type of thing. So it is interesting to see how that changes over time. The majority are finding their home through some combination of using their real estate agent and using the internet to get housing alerts, or perhaps seeing advertisements of when homes become available. And then as far as websites, are we using websites to look at homes? Yes. And what are we looking for on those websites? Number one, we're looking at the pictures. Number two, we're looking at the photos. And number three, we're looking at floor plans. I always like to provide floor plans with my listings. A lot of agents don't look at this, but I think buyers find them incredibly valuable. So if you are planning to list your home, plan to get a floor plan out there so that your buyer can really understand, where does their furniture go and how is this going to work. For some people, it's not a big deal, but for some, it's extremely important. And I think putting as much information out there to help your buyers feel comfortable, whether they're analytical, whether they're creative, you almost can't give them too much information. It makes them feel like you're being transparent and that they understand the process and they can grasp that logical side onto the information they need to make them feel safe. So as normal, we have the large majority of transactions being assisted by your real estate agent. Now, some are going through the builder, and I want to warn you guys, I know you see those new home construction places with the beautiful flags, and it's like, come in, tour with me. And those are all agents in there. They are all representing and advocating for someone. And guess what? It's not you. It's the builder. They are like the wolf in disguise, right? The wolf in sheep's clothing there. So I want you to be really careful. If you go to those new home construction sites without your agent, oftentimes they will register you, and you cannot use your agent unless you want to pay your agent out of pocket, which you don't. So you basically have no help, no representation, no one on your side. It's just the builder's agent telling you exactly what to do and sign here, and don't worry, everything will be fine. And I've been to enough inspections with new home construction. Even though it looks nice on the outside, it's not always fine. There are things that you really need to know. Different builders have different standards of quality and ethics. So I would suggest you can still buy a new construction home. That's totally fine. But have your agent bring you to that first visit, go with them, so that you don't get trapped into this no representation situation. And then we see very few people selling by themselves. It seems like that's in an uncertain market that becomes even less desirable to do. So what do people actually want in their agent? Number one, help finding the right home. Number two, help negotiating the terms, especially the price, and help with paperwork, comparables, determining what they can afford. All of these are services that a good agent can and should provide. And I want you to make sure that you know what they are so you can ask for them. And when you're interviewing your agent, you can let them know that these are the things that are important to you, so that they're there to meet your needs. So a lot of people look at their home as an investment, and this has become, controversial. Some people, like podcasters and stuff, are like, no, you should rent your home and everything. And so it's a great question to ask, but overall, through the years, what do people think? And what do they think right now? This year, they still feel like it's a good investment. 80% think it's a good investment, and 15% are like, I don't know. So it's only 5% who feel in that context that it's not a good investment. And then the question becomes, is it better than stocks? Because a lot of these podcasters who say you shouldn't buy a home, you should invest, save the money that you would have spent on the home and invest it in stocks. Is that actually a better idea? Let's see. Half the people think that real estate is better than stocks. 35% think it's the same as stocks. And only 15% think that stocks are better. So that, I think, comes down to the way that you do your math overall. Real estate has a 4% appreciation rate. Stocks have a maybe 8% appreciation rate. So if you're just buying a house cash, the stocks could have a better return. But if you're using leverage and you're saving on rent, like, there's a lot to be said, and you're forced to save every month instead of, oh, I forgot to invest in my stocks because I had to buy something, right? So I think that's a lot of the reason. And so many of the older generation that I talk to, their home is where their wealth is. They did not, in fact, build out a stock portfolio separately like the podcaster might have advised. They didn't do that. They have their house and they need to sell their house, and that's their retirement plan. So think about that. I do both. I think real estate is great, and I think stocks are great, and I invest specifically in both. But I'm happy to talk with you about your strategy and see what makes sense for you. 75% or so of their people love their agent and are planning to work with them again. And people tend to be very satisfied with their agents. So I would encourage you, if you are thinking about entering into a real estate transaction, to utilize us. People like me, they're all sorts. There's the kind that used to be a hairdresser. There's the kind that's in a rock band on the side. There's the kind that used to be an attorney, a CPA, right? Everybody has their own background. And I think a lot of agents are whitewashed as like everybody's the same. But I would encourage you to find an agent who you think is smart, reliable, well-versed in the market, is keeping up with the market, and is sharp when it comes to what's going on, and honest in terms of how they treat other people, other parties to the transaction, and you. It's very important. A lot of people don't interview more than one or two agents. So make sure that you choose good people to interview and are clear on their approach to the nuances of the real estate transaction. So thanks so much for watching. It's Emily Cressey with Keller Williams Greater Seattle, here to help answer your questions. Feel free to jump onto our news site on our website. We have a page where we are updating you with what's going on in the real estate market every month, and look forward to having you join our email newsletter there and helping answer any questions that you have. Again, I do work in Seattle, but I invest in real estate all across the country and all sorts of different states at different times for different reasons. So if you are thinking about investing or you want to be introduced to an excellent agent in the area that you're looking at, please feel free to reach out. I have a large network of contacts. I'll be happy to put you in touch with someone that's going to be a good fit for what you're looking for. So until then, thanks so much, and I will talk with you soon.